So guys, welcome to VRD Nation. In this particular video, I want to share with you the key learning that I had from this book right here. It's called The Psychology of Money. A very interesting book and a lot to learn. But instead of focusing on the book, I will focus on the key learning that I had from this book that I applied in my own real life and I benefited from it. So that will be of more meaning to you rather than just talking about this book. The book starts with a very interesting story of a person named Ronald James Reed, who came from a very poor background. So he was a car mechanic for about 25 years, and then for the next 17 years he used to wipe the floors of showrooms, right? So came from a very, very poor background. But at the age of 92, when he died, he made the headlines because at the time of his death he had $8 million in his bank account, and most of that money he donated to charity. Now, how does a person like him become a millionaire, right? That's the question that a lot of people started asking. Well, it turns out that the secret of him being a millionaire was not that big of a secret, right? So what he did was, throughout his life, whatever minimum saving that he had, he used to buy stocks of blue chip companies. That's all he was doing. Just keep buying stocks of the blue chip companies, and he never sold. Whatever recession, whatever stock market crisis happened, he never sold even a single share, and the stock market did the rest. Now, in contrast to this story is the story of Richard Foscon. Now, Richard was a very smart guy, right? And he went to Harvard and then he joined a company called Merrill Lynch, which is one of the biggest investment management companies in the whole world. And not only he joined that company, he also rose to a very senior rank in this company. So he was very successful, he was very smart. But he also had some very expensive taste. So for example, he bought a house which was about 18,000 square foot, where he had 11 bedrooms, he had 2 swimming pools, he had 2 garages, right? He had so many of these luxurious things in that house that for maintaining that house itself per month, he used to spend about 50 lakh rupees. Now, everything was going fine in Richard's life until the 2008 financial crisis came along. Now, it hit him harder specifically because first of all, he lost his job. And secondly, he was not able to maintain the property which he had because he had to pay this huge money every month. So he had to sell his property first of all, and then he had to declare bankruptcy just to come out of this whole situation. Now, we have all heard about stories like this before, right? And the moral of these stories is always the same, that you have to live within your means, you have to keep saving, you have to keep investing for the long run. And you know, that's kind of the obvious thing to have. But what is more important, what is I think underappreciated, is to understand our relationship with money, right? How do we behave with money when we have it? And how do we behave with money when we don't have it? And that is exactly why we need to understand the psychology of money, because on the one hand, we have opportunities like Ronald Reed, where we can create some immense wealth in our life. And on the other hand, we have the possibility, just like with Richard Foscon, where we can make some very expensive mistakes in our life and we can lose whatever we have. So that is exactly what this book is all about, to understand the psychology of money. And here are the key takeaways from this book. Takeaway number 1, our childhood experiences shape our worldview. So whatever experiences that we had when we were a kid, right? That experience that we had, that understanding that we had by looking at our parents, by looking at our relatives, that may account for, let's say, 0.0000000001% of how the world really works. But that view, that understanding that we develop by watching our elders is how we believe 80% of the time the world works. So in other words, whatever we see, whatever we experience when we were a kid, that shapes our worldview, and that's how we think the world really works. Now, some of us came from families that were very conservative. They just used to, create fixed deposits and just keep money with themselves, no investing whatsoever. Some came from families that were very active in, let's say, investing in properties. Some come from family which were very active in, buying gold, right? And even though after we grow up and we have a better understanding of how the world works, we are still deeply impacted by what we saw our parents do at the time when we were kids. For example, in my case, I come from a humble background, and growing up, my family was not very savvy in terms of investments. We didn't have a lot of savings, we didn't have a lot of money, but we did have some gold, right? And my mom kept that gold for a very long period of time. And then a time came where we had to deal with some financial crisis, and by selling that gold, we were able to navigate through that tough time and we were able to move on, and of course things became better over time. And because of that experience, even till date, I have a soft corner towards gold in my mind, even till date, right? Even till date, I like to buy gold. I don't like to sell it. Even till date, I believe this is a safe investment, and irrespective of whatever evidence somebody presents to myself, I will still have that favorable opinion of gold because that is how my childhood experience is. So this affiliation that I have towards gold, is it rooted in the realities of today, or is it rooted in the childhood experiences that I have had? And that is a very important question to answer, because is gold even till date a safe haven? Is it a good match for my long-term goals? Because that's the question that I have to answer today, not based on the facts of yesterday, but the facts of today. Now, in the same way, a lot of us grew in families that were afraid of investing in the stock market, right? So I remember a friend of mine, his father used to say in Hindi all the time that ye stock market se jara dur rehna, ye pura satta bazaar hai, means it's a gambling, it's all gambling. And he was actually right at that time, because the stock market culture is relatively new in India. And at that time, the equity culture was not there, the regulatory framework was not there, right? So there were a lot of fraud, there were a lot of issues, there was a lot of manipulation that was happening. So he was right at that time. But does it mean that 20 years down the line, 30 years down the line, 40 years down the line, we still carry the same perception about the stock market? And should I carry and should I give the same perception to my kids, that when they are in their 20s and 30s and 40s, they carry the same perception that stock market is all a gamble, right? So we have to at some point stop and ask that whatever perceptions that we are carrying from our parents and our relatives, is it still valid or not? Now let's talk about the takeaway number 2, that is the power of compounding. Now I will start with a little puzzle for you. Imagine there is a lake, and in that lake there is a small patch of algae. So algae, for those of you who don't know, that's like the green plant kind of a thing that floats on the surface of these ponds and lakes, right? So this algae grows in size every day and it becomes double every day. So from day 1 till day 50, on the day 50, the whole lake is covered with algae, right? So the question to you is that if on the 50th day, algae covered the whole surface of the lake, when do you think the lake was covered half by this algae? Now instinctively, most of us, we will think that, okay, if the algae took 50 days to cover the whole lake, most likely it took, let's say 25 days for it to cover half of the lake. But the answer to this question is always surprising, is that it is the 49th day when the algae was covering half of the lake, right? And on the 50th day, it doubled in size and it covered the whole lake. And that is exactly how compounding works, right? We don't even know that it is growing, it is working in our favor. And up until that 49th day, up until a threshold is crossed, we will not realize how powerful compounding is. But when we cross the threshold, then we see the real magic of compounding. Now let me explain this from a real life example of two world-class investors, Warren Buffett and Jim Simons. Now I'm sure a lot of you already know about Warren Buffett. Jim Simons not so much, but I will talk about him in a bit. Both these investors are in their 80s and both these investors have become billionaires by investing in the stock market. As of today, Warren Buffett has a wealth of over $100 billion and Jim Simons has a wealth of about $23 billion. But here is the thing. Warren Buffett's return from the stock market is about 22% on an annualized basis, whereas Jim's returns from the stock market in the same period are about 66%. So clearly the puzzle here is that if Jim is making 3 times as much as Warren Buffett, then why is his wealth not even the 1/3 of the wealth of? So the answer to this question lies in time, right? Warren Buffett has been investing ever since he was a kid, right? So for about 70 years, Warren Buffett has been investing, and this annualized returns of about 22% that he has generated has compounded on an annual basis and has created this massive wealth that we see today. Jim Simons, on the other hand, did not find his investing strategy up until he was 50 years old, right? So of course he has made substantial money since he discovered his strategy, and then he started this hedge fund called Renaissance Technologies. But still the time is not on his side. So just like the kind of effect that we saw in the lake on the 49th day, right, when that algae covered the full lake on the 50th day, that is exactly the power of compounding that Warren Buffett is experiencing right now. And even though Jim Simons, of course, doesn't have the time on his side, but if you just imagine for a second, that if Jim Simons were investing for the same period at the same rate as Warren Buffett did, you know how much wealth he would have? Jim Simons' wealth would have been, in the last 70 years, would have been more than the GDP of the whole world put together, right? So right now, of course, I hope at some point he gets there. But the point that I'm trying to make here is that the power of compounding comes with time. And what it means for us, the retail investors, is that the longer we are invested in the market, the wealthier we get, because the power of compounding starts working in our favor. Now, the takeaway number 3 is that do not move your goalpost. Now, this is interesting because we all like to, grow in life. We like to set targets, and then once we meet those targets, we like to, set more ambitious targets so that we can go more in life. So, in the beginning, when we are in our 20s, we just want to, buy a house. We need to have, let's say, 1 crore rupees in our bank account, and that is the target that we all want to, achieve at some point. And once we achieve the target, now we set up some new targets, more ambitious target. Now we want a bigger house. Now we want a bigger car, right? And now we want to go out for vacations, right? So whatever is our new target, and that's a good thing. That's really a good thing, because that ambition keeps us pushing to, do more and more, so that we achieve more in our life. But when it comes to the long-term goals, we also have to be honest with ourselves, right? This pushing of the goalpost is very good when we are in the initial stages of our life, but when we are in our 60s or when we are in our 70s, we cannot keep pushing this goalpost too far. We cannot say that, okay, we had this goal up till this time, but I'm not happy with it. Now I want to have something more. And this is one of the problems that we are facing in our society, that in spite of generating so much of wealth, in spite of generating so much of money, still people are unhappy. Why? Because we are living in a world of social media, of Instagram, of Facebook, or Twitter, where we see our friends, their friends, or some celebrity posting photos of some great vacation that they had, or the expensive car that they bought. And now whatever that we have done with our own life, whatever goals that we have achieved, they all look minuscule, they all look very ordinary, they all look very boring as compared to that, right? And now all of a sudden, now you were happy until you saw those pictures, but all of a sudden now you are unhappy. Because if you always keep comparing yourself with others, you will always feel insecure, you will always feel unhappy, you will always feel that you have underachieved in your life, right? So stop comparing yourself with others, have some long-term goals, stick with them, and if you can achieve them, you have done enough. Just be happy, just be content that you got there. Takeaway number 3, you only need a few big wins. Now, one of the biggest misconceptions that a lot of people have is that you have to be right a lot of time to be able to make money from the stock market. Whereas the reality is that you only need a few big wins to win at this game. Now, take for example, venture capitalists, right? A venture capitalist firm, for example, when they are investing, they are not investing in one company. They are investing in hundreds of companies, and they know that half of the companies that they are investing are not going to be profitable. They know it from the get-go, that half of them will not make any money. So they are aware of that. And they know that maybe another 20-30% probably will break even. They will just give maybe a little bit of a return. So that venture capitalist firm just needs one Zomato, one Paytm, or one Baiju to not only recover the losses that they had from other companies, but also to become immensely successful. That is exactly the same kind of a mindset that you have to bring in investing as well, right? Most of the time in the stock market, you will be an average investor, and there is nothing wrong with it. But there will be a very short period of time during which you have to make some decisions. And how you behave on those specific months, those specific weeks, those specific days will decide whether you become immensely wealthy or you stay as an average investor. Napoleon Bonaparte had a very interesting saying that a good leader, a great leader, is someone who behaves normally when everybody around him is going crazy. In the same way, an intelligent investor is one who can behave normally, rationally, when everybody around him or her is behaving irrationally, is going crazy. So what did you do when the stock market crashed in 2001? What did you do back in 2008 when the market gave an amazing opportunity? What did you do last year in 2020 when the market gave such an amazing opportunity, when amazing companies, big companies were selling at rock bottom prices? Were you scared, or did you see that opportunity of investing in these companies at such an amazing price? So if you can focus on these opportunities when everybody else around is going crazy, if you can just be rational, you can be immensely successful. Now the next takeaway is a very philosophical question, and that is, what is the purpose of money? Why do we need money? Now I'm sure most of us, we don't really pause and think about it, but it's a very important question. So just think about it, right? So back in my 20s, when I was earning and I wanted to go out, and I worked in Japan, I worked in US, my goals of earning money was to have a better house, to give all the comforts to my family. And then when I was in 30s, my goals were to become financially independent, to secure the future of my kids. But now when I think about money, the purpose of having money, the purpose of making money for me is much more fundamental. The purpose of making money today for me is to gain freedom. And freedom of what? Freedom over my time. So freedom of doing what I want to do, freedom of, let's say, spending time with my kids, freedom to pursue my own passions without having to worry about what my boss is thinking or what somebody else is thinking. I can do what I want to do because I am financially free. So the highest form of wealth is waking up every morning and saying to yourself that today I can do whatever I want. Not what my boss wants, not what somebody else wants, what I want. What is that I want to do today? That's what money is for, to gain freedom over our own time. So the next takeaway of this book is, wealth is what you don't use. So in this culture that we live in, we see a lot of people, who are showing off. They have, Ferrari, they have Maserati, they are making a lot of money, they are showing off, and that's what we believe they are, like, rich people. But at the same time, there are a lot of other people who can afford to buy a Ferrari, to buy a Maserati or a BMW, but they choose to live simpler lives, right? So the people who are driving these big cars, the people who are living these lavish lifestyles, we can call them rich. And the people who have the capability of doing all this, but they choose not to do it, we can call them wealthy. So richness is visible, wealth is not. And you need to make a decision that what is that you want to become. Do you want to become rich or do you want to become wealthy? First of all, there is nothing wrong with being rich, or there is nothing wrong with being wealthy. But if you want to be rich, there are a couple of things that you have to keep in mind. Number one, if you want to sustain, because you have to keep spending money to stay rich, that's how rich people are, you need to keep earning at a much faster rate, because your levels, your standard of living will keep going higher, right? So it's much harder to stay rich. As we saw in the case of Richard, it's much harder to stay rich than it is to stay wealthy, right? That's number one. So you have to make that call. The second thing that you have to realize is that it's very easy to have role models that are rich, right? So people around us, people on social media, people on TVs and celebrities, it's very easy to see the kind of lifestyle that they're leading. But wealthy people who have the money, who have the capability, but they choose not to live that kind of a lifestyle, those kind of role models are very hard to find, because of the very nature that they live simple lives, right? We don't necessarily know that they have that kind of money, right? So it's hard to find role models that are wealthy. But if you can find role models that are wealthy, you need to learn from them just as much you need to learn from people who are rich, because both of them are successful. It is just that one decided to show off and the other decided to keep the money for what? For having control over their life, for having the control over their time, for having the control to do whatever they want to do in life. Now the next takeaway is that being reasonable is better than being rational. Now all throughout our life, we have been told that when it comes to the matter of money, when it comes to investing, when it comes to trading, whatever is the case, whenever money is involved, you have to be cold and you have to be rational, you have to look at the facts, you have to make your decisions based on that. And I agree, for the most part it is true. But we also have to realize that we are human beings, right? We are not robots, we are not spreadsheets. So when we see this, it's more like a spectrum. And on one end of the spectrum, we have this cold, hard, rational thinking. And on the other end of the spectrum, we have this emotional, feeling-based decision making. And we need to avoid both ends of these spectrums. We need to find a middle ground where we can have decisions based on the facts, but at the same time we need to be able to live with those decisions, and this middle point is called being reasonable. So I will give you guys an example of this. So for my daughter's college education, I have a couple of portfolios, and in those portfolios I have some metal stocks, right? And these metal stocks, they did extremely well. Some of them I was making 100%, 200%, 300%, even more than that, and I actually made a video about this. And at one point I had to make a decision that do I want to stay in this portfolio, keep riding this wave, or should I book my profits, right? So I decided to book the profits in my portfolio and I decided to come out. Now, was I being rational? Was I being completely cold, calculated, rational person? Probably not, right? Because there was no specific reason for me to exit, right? The stocks were doing perfectly fine. There was no necessary reason for me to come out of this portfolio. But was I being completely emotional? Probably not, right? Because I was sitting on a lot of profit and it is for my daughter's college education. So it was very reasonable for me to secure whatever gains the market gave me. So this is the kind of a thinking that I like to think that, okay, being rational is good, but being reasonable is better because I can live with this decision, right? I can explain my daughter 20 years down the line that why did I come out of this portfolio, because it made perfect sense from a reasonable perspective. Now the problem that I see with a lot of people is that they come up with this, back tested strategies with 2 or 3 growth stocks, and that too in the hindsight. And they say that, okay, if you invested in these 3 stocks and you stayed in these stocks for let's say 20 years or 30 years, you probably would have generated like 10 times or 20 times returns. And the example that I give them is that they give me, right? So one of the favorite examples of that these people give me is that of Titan. That look, Titan was a penny stock, and let's say you bought Titan at 5 rupees, right now it's at like 1,000 rupees, right? So that's how people think. And I pose a very important question to them that 2 times in the life of Titan fell down more than 60% within 1 month, right? Back in 2008 and recently in 2020, 60%. So let's say you had 1 crore rupees in Titan and you lost 60 lakh rupees, of course notional loss, not a real loss, but would you be able to go back to your home and tell your wife that yes, we had 1 crore rupees up until last month, but because of this correction we lost 60 lakh rupees. But don't worry, all my back tested result tells me that we will eventually make more money. It's okay, don't worry about it. Do you think it is reasonable to assume that your family will understand this, right? So this is the difference, guys. Making a decision based on rational facts is one thing, but being able to live with those decisions is completely another. And for any reasonable person to assume that your family can live with a loss of 60%, this is why people incur losses, right? Because they cannot handle the things that they think that they can do, but their mind is not ready for that, right? So make decisions that are more reasonable than rational, because you can live with them, you can manage them, have the right kind of diversification. Even if it means that your returns are lower, you can at least sleep well at night without having to worry what will happen the next day. So guys, these were the key takeaways from this book, and I hope that you guys learned something. There is another book on Jim Simons that I want to make a video about, where we can talk about his journey of how he became a billionaire from the stock market, what kind of strategies he used. And I hope that you guys are learning from this kind of videos, and this is the first in the series where we are discussing a book. Let us know in the comments below if you like this video and you would like us to make videos about Jim Simons and keep going in this series. I like it because I personally love reading books and I like to share knowledge. So let us know and we will keep doing more of this.